Hi, you guys. I see there's a lot of new faces out there, or new names anyway. I don't have any faces to the names, but one thing I mentioned at the beginning of every single webinar, and it's because I truly believe this, watch it again. It doesn't necessarily have to be on implementation of options into a portfolio, but watch another broken wing called butterfly webinar, because we're going to go through a lot of things. I like to try and explain this stuff, especially for the newer option trader. And one thing that might happen is some of these nuances might fly by you. So the second time through, when you're having all these, or the first time through, you're going to have a bunch of questions probably, or trying to figure everything out. Second time through, you will be able to comprehend it more. And for some of you guys that are savvy option traders, it'll help you remember some of the guidelines that I have set out for implementing this strategy. It's not like you're going to go on Investopedia or something like that, and they're just going to tell you how to do this. I'm going to give you specific strike locations, dates to expiration, all of that stuff, and I'll explain why my methodology is what it is. And hopefully you will be able to understand it a little bit better than as to why we're setting it up this way. It's not just like trying to memorize it. I'm trying to give you guys a thought process behind it. So implementing options into your portfolio, this is, I think, very important, especially right now in this type of environment, what we're going through. Options are huge, and it's really the only way to kind of beat the S&P or to beat the overall market, right? Because what we're doing is we're creating yield in our portfolio that we wouldn't otherwise be able to achieve. So great thing to know and or start implementing any type of option, not even just necessarily the broken wing call butterfly. All right, so take that for what it is. Anyway, let me talk about myself for a minute. For some of you guys that may not recognize me, or some of you may recognize me from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, and then moved to Chicago after graduating with a finance degree. Switched from psychology to finance, and still believe that my psychology degree is probably better suited for trading than even my finance degree at some point in time. One thing was funny on the floor, people would ask me what the different economic data would really imply, and knowing that from my finance kind of helped me out. But the trading psychology is probably more important whatsoever than anything else. Also, please take a moment to go over this disclaimer. We are an educational company. I may be talking about some stocks that I have in my portfolio, and I may even be talking about stocks that I'm thinking about putting, or ETFs that I'm thinking about putting into my portfolio. I'm not trying to get you guys to jump on board with that trade. It's really because I'm looking at my portfolio and what I think I need in that portfolio. I don't know what's in your portfolio, and I don't even know what your risk parameters are. So there's no way I could give you investment advice. Also, please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog for all kinds of market wisdom, hopefully, but mostly probably snark. And you can follow us on our parent company at ProTrader Strat. Facebook, we have a lot of content we're throwing out there, daily market commentaries. That's where I talk about all my trades, when, where, and why I'm doing it. If I'm not doing anything at all, I'm still giving a daily market commentary, talking about the economic, geopolitical stuff and my market analysis. Sometimes it is good just to sit on your hands and watch your portfolio rather than having to be active every single day, which is something that took me a long time to get over. I always felt like I had to put something on every single day. And, you don't necessarily. Sometimes it's better just to kind of sit by and write it out. All right, so broken wing call butterfly. We are going to be talking about something that other people might call as a skip strike butterfly or a wounded wing butterfly. I'm always just going to call it the broken wing butterfly. The reason why is because that's what we would call it on the floor, and that's the way it's stuck in my head. But skip strike butterfly is something that might make you remember it a little bit better. The idea on the skip strike butterfly is is a normal butterfly is equal distance on the wings. So when we're talking about, let me get my pen out here and get it all set up. I probably should have done that earlier. So basically, here, actually, you know what I'm going to do? I'm going to pull up the platform just to take a look at it real quick. All right, let's pull this over here. So normally on a call butterfly, what we're going to be looking at is taking a butterfly and we're going to break the wing on it. In a sense, what we're going to do is sell a call spread in there. So normally what we're going to be doing is we'd say, for instance, buy the 80 strike here. I don't even know what I'm looking at, Best Buy. So buying a strike here, and then we would sell, like go out $5 or something. We'd sell this one twice. So you'd sell two of those, and then you come up $5 higher and you would buy these. All right. So the idea is that is our butterfly. All right. But what happens here is instead of doing that, what we're going to do is if we were buying this 80 strike right here, buying the 80, selling two of the 85s, just try and make sure I line it up. So selling two of those, right? Well, we're looking at this 90 strike here, but we're going to skip that strike and go out to the 95s to buy it, all right? And what that does is we're skipping that equal distance call and going $5 further. What that kind of says is, you know, we said we were buying this one here before. Well, now we, in a sense, are selling a call spread, like we're on the broken wing, we sell out of that one, and then we buy this one further out. So basically, that embedded short call spread is what we were talking about on the floor. That one we're collecting a credit for, in a sense, synthetically, to give you a better idea. And that is what gives us that extra credit, because we're collecting a credit here, makes it so the downside, we have zero risk, all right, to the downside if the market goes down. You know, yes, we are adding more risk to the upside. So, you know, why would we implement this strategy? Well, because we're neutral and we're worried about the downside. Now, think about the scenario we're setting ourselves up in right now. It seems like this whole course, I haven't ever had a course where it's lined up almost perfectly for the types of environments we're experiencing and the way that the market's been reacting, right? You know, there's a lot of people out there that it's sad, you know, we've gotten the market at kind of traded up, right? And then we got that huge sell-off, and now we've retraced, and in some cases, like the NASDAQ, are basically positive, you know, before basically this week, we were looking at positive on the year. Now you think about what we were thinking going into January is that we were seeing extreme unemployment. We were seeing the economy like firing on all cylinders. And then we had this coronavirus thing. Well, that sent the market tanking. Now we're right back to where we were in January. I don't know. That's a bit of a heavy lift for me, right? So we've gotten this recovery. We've done pretty well. Now, the idea is I don't think we're going to probably go up to those all-time highs, but we might trade sideways like this, or I am worried about the market coming down. You know, we're starting to see places open up, and I'm worried about a little bit of the downside risk. So I don't want risk if we trade to the downside. And I'm willing to believe that we probably aren't going to go up there. And therefore, I'm able to sleep at night thinking, you know what, I'll add a little bit of risk to that upside for the market neutral kind of outlook I have right now, especially in the broader markets. So that's, you know, when we're getting into this strategy, you know, we have to come up with an assumption, right? And anytime you're doing any type of strategy, the idea is you come up with an assumption, and then we are going to go through the process to find out what is the best strategy for that assumption, right? If I was completely bullish on the market, which you guys very well may be, and there's stocks out there that you could be very bullish on, you know, like maybe one of the drug stocks, it's Gilead or AbbVie or something like that, you know, then this wouldn't be the right strategy. There's better strategies out there for a bullish market assumption. But the idea is right now, let's say I've come up with an idea on XYZ, and XYZ, I am market neutral right now. I think it's a neutral or equal to where we are right now. So this would be a strategy that I'm considering. So if I have a neutral assumption, and then I'm thinking, you know what, but I don't want any risk to the downside on this, then you start thinking, well, if I had on an iron condor or an iron butterfly, something like that, those are market neutral strategies. A butterfly is a market neutral strategy, but there's risk to the downside in those, and I don't want that risk. So how do I get rid of that risk? Well, it's with the broken wing butterfly, and that's what we're going to be. That's why I would lean towards this. Is my thought process? Yeah, I'm neutral here, but I'm worried about the downside. I'm not too concerned about the upside. So what strategy do we go with? Well, then that is something like the broken wing butterfly. Neutral, and I'm worried. If you're neutral and not worried about the downside, completely neutral, then you'd probably look at something like one of the ones that we've already done, and that is like the iron condor, the iron butterfly, a call butterfly, stuff like that. If you are really just market neutral and you're not really worried about the downside. I'm trying to give us a scenario right now where we've come up with an assumption on something. We're looking at the markets and we're saying, yeah, I'm pretty market neutral right here because we've gotten this nice move higher, but I'm a little bit worried about the downside. So if you get that worry about the downside, then that's where this strategy comes into play, okay? Got here late. Is this recording available after the review of what I missed? Yeah, and Todd, you haven't missed a whole lot right now, so you should be pretty good to go. All right, so that's the assumption I've come up with. And, maybe it's XYZ. I actually have a pretty good one for an example coming up here in a little bit that we'll get to. So a little bit long on the tooth with the skip strike butterfly, but, the idea there is there's an embedded hidden short call spread in there, and that's what's financing this whole downside, taking away the downside risk. So like I said, we do want to have market neutral to worrying about the downside. A couple of things with this is we have to have that market neutral, and, we're questioning downside, right? We're questioning the downside risk. That's pretty important. Is if you just had the market neutral assumption, there's better strategies out there, but you've got this light bulb going off in your head or an alarm or something. That's not a very good light bulb. That's more of like an Edison light bulb, isn't it? But anyway, the idea is that you're worried about some downside risk in here. All right. We also need to have some high implied volatility. And the reason why we want high implied volatility, because, normally we're going to be kind of selling these and that doesn't really matter, right? Well, what it does is it allows our wings to be a lot bigger, okay? If we did this in low implied volatility, our wings would kind of look like that, all right? So, and I'm looking at this as if it was the option montage here, right? The lower strikes are down this way and higher strikes this way. So the idea is in higher implied volatility, we're able to get further away where we're defining our risk, and therefore that gives us a higher probability of success. We got a lot more room to be wrong than if we did it in low implied volatility. All right. We need to make sure that we're collecting our credit or doing it for zero outlet money. All right. So do not do this for a debit. All right. Don't do this for a debit. Why? Because if I'm adding risk to the upside, I need to be paid off for that, right? And that means if I'm adding risk to the upside on the market, and I know that it looks a little wanky because I'm drawing it down, but I'm thinking of the option montage. These are increasing to 125 or something like that from 100. And this would be like the, that's not a very good example, but 100s, and then these would be like the 90s. All right. So if I'm adding risk to the upside on the calls, right, then I need to make sure that I'm getting something in return. And that's basically eliminating the risk to the downside. And if you're collecting a credit, or zero, you've eliminated your risk to the downside. Okay. Can we do a put butterfly for the downside risk? If you're worried about the ups, or if you're worried about the downside risk, then you would want to do this. If you're worried about the upside risk, then yes, you could do a broken wing put butterfly for that. Like you think, I don't think this market's going to correct and go down, but I think that we are going to go test those all-time highs. If there was any direction that it would go, then yeah, you would look at this kind of very similar to the call, but do it on the put side. You're adding more risk to the downside in order to not have any risk to the upside. And if we pin the short strike on the downside on the put butterfly, then that's where you make your max profit. Same thing with the calls. If we nail the number on the two that we're short here, then that's where you're going to make your most money. All right. So the idea is we're buying like in the money, or in the money. I like to go at the money, and I don't mind if you go slightly out of the money, especially right now. Okay. So you can go slightly out of the money on the calls because we've had these big moves, and maybe, you think that you have a price target in mind. Well, wherever you think the market is going to track to, all right, and go to, that's where you want your short calls. That's where you think the market is going to be. Well, that's where you kind of want to pick your strike location for your short calls, because we ultimately are going to be collecting a credit for these calls, right? Well, that is really what's paying for all of it. And therefore, if we're collecting a credit and all of those things, we want these to kind of expire worthless. All right. So if these calls expire worthless, that's when we make the most money. So really, if it's expired 1 penny below our short calls at expiration, then that would be our max profit. All right. That makes sense? And I'm going to give a couple of examples here very shortly. So bear with me. Now, it is a play on Vega because I talked about that. Remember the butterfly? We want our butterfly where we're selling 2 short calls here. I could probably do that as a call. All right. And then we're going to sell a call here that's selling the call that's basically, let's just call it at the monies. And then we're going to be skipping a strike way out here and buying that call in the money, selling those 2 calls, and buying that one. And the reason why, when volatility contracts, it actually, like I said, if you set this up in low volatility, we kind of want it to be where we sold those calls here and bought this call here. It kind of makes it contract, makes those wings contract, and our call would be out here, right? So as volatility contracts, it's going to kind of make these wings a little bit shorter as we go, all right? Which is what we would want. And theta. Anytime we're doing a play on Vega and we want to sell in high volatility, sell in high vol, right? Or we want to exploit theta. That means, basically we want theta to go down as well because we're collecting a credit. Anytime you're collecting a credit, you want to sell high volatility and you want to exploit theta decay. All right. So we want to exploit theta decay. So when we're doing that, exploiting theta decay, when we're trying to exploit theta decay, we want to get into that month that has, basically the best theta decay. And that's usually 35 days to expiration is the wheelhouse for exploiting theta decay. And I'll show you couple of things out, we can figure out that as well. I've got a graph to give you a little bit better representation. All right, so a traditional butterfly, you've got to nail the number, right? So you've got to hit those shorts. You got to hit the short call strike. That's what I'm talking about by nailing the number. You got to hit it right there. It is going to have a lower margin requirement on that, but with this one, we are going to have a higher profit potential on this strategy. We're going to have a higher max loss because anytime you have a higher profit potential, you're risking more. It's risk reward, right? If you're risking more, your reward should be more. But the beauty is we have protection on the downside move with the broken wing butterfly. So a little bit better there. All right, so our max profit is that lower strike minus the middle strike. So basically our lower strike is the at the money call, right, that we're buying, and our short call. So it's basically the width of the smaller spread. Because remember, we're buying one call here. That's let's just say it's the 90 calls, all right? And then we're selling 2 calls at the 100 strike, let's just say. And then we're buying one that's a little bit further away at the 110 strike. 120 strike. See, I skipped the 110 strike, right? So I'm skipping this call. That would be equal distance. Normally, that's the regular butterfly. So we're looking at the distance here, right? That long call spread. That's our max profit is, in this case, it would be $10 plus the credit received, which is probably going to be about 60 cents or something, okay? So our max profit in that case would be $10.60. And then, of course, our max loss is going to be that higher strike, which we are looking at, and the 110. So if the max loss is starting to happen, it's going to happen at that skip strike, which in our case was the 110 calls, right? I skipped that strike, and the 120 calls there, all right? So it's $10 minus the credit because we're collecting a credit. So in that, if we collected 60 cents on this trade, then basically our max loss is going to be $9.40. Our max profit in this case was $10.60. So our reward is better than our risk. It's going to basically be very close to kind of risking one to make one on this. We're going to get out early though. We're not going to have to write this in. Why do you say the wings contract on low volatility? Well, because where we set this up in high volatility, as volatility expands, the premiums go up. And as those premiums go up, we are able to get further away from what the underlying is trading. So in a sense, you think of it as a balloon, and as volatility comes into the market, the balloon, the radius of that balloon gets bigger and bigger, right? Well, when volatility comes out, it kind of squishes back down, right? So the idea is you want to sell it when that volatility is high. Is that a good analogy? As volatility expands, the premiums go up and, we're able to get further and further away. Why do you minus the skip strike and not the short strike? Well, because this is where our risk is. Our risk starts happening above the skip strike. Here, let's pull up hold on. Our skip strike is, our break even is at that skip strike plus the credit, all right? And the width of the long spread. And the reason why the width of the long spread is because that is the thing that's going to be paying us off, right? So if I pull up the platform just to try and let me find something beside Best Buy because it doesn't really fit the rules. What I'm talking about here is now a normal butterfly, all right? We would be looking at, we're going to buy the ones that are just out of the money, and then I'm going to go $5 higher, Anything above $100, you're kind of looking at a ballpark of $5 higher. So I'm looking at the 124s, and then I'm going to go down to the 29s, sell those twice, right? And then a normal butterfly, I'd go another $5 higher and be the 34s, right? So that's your normal butterfly, and you're doing it for a debit. You have risk to the upside and risk to the downside. So we built this out like a regular butterfly, and we can go over and look at the Analyze tab. Let's just analyze this trade. I don't know why that's in there. That's not what I wanted. $4, why is that doing that? Did I do that right? 5 to the 9. Oh, I went $6 higher. Let's go back to this trade. So I need the $5 higher would have been the 4s. That's better. So let's analyze that trade. All right, so that should be there. Let me slide this over a little bit. So you can see we've got risk to the upside, risk to the downside on this, right? Now, max profit is pretty good on this versus our loss, but think about it. We don't have a whole lot of room to be wrong. If it rallies too much, we're wrong. If it goes down too much, we're going to be wrong as well. Now, this is what I was saying about going there and looking at this trade. In a sense, let me go back again because I want to do this all over again. So we want to buy this one, a regular butterfly. We buy that one, and then we go $5 higher, sell the 9s twice, right? $5 higher, we're going to be doing the 34s, 134s, right? So that's basically the strategy we just set up. $5 equal distance away. Now, this is what I was talking about. Synthetically, if we want to do the broken wing butterfly, what we want to do is put an embedded short call spread in this. So I'm going to sell a call spread. So I sell the 134s, and then I go $5 higher, and I buy the 139s. Okay, so that's what I was talking about, an embedded. You can't see it, but it's embedded in there. So that short call spread that I just kind of legged into created a credit. All right. So that credit makes the Analyze tab look like this. Get rid of that one. Gotta remember to. So now our downside, you can see, if it goes down, we get to keep that credit. All right. And that's because the width of the spread. Remember, we got the short call spread. Let me pull this up. Do it. Maybe I can do it like this. I don't usually do it this way, but right. So we are long the 124s, which is right here. So we're long a call here, and then we're short 2 calls here, right? And then we are long the 139s, which is right here. So we're long these. All right. So as the market goes down, this call spread, the collection pays for the width of this spread, right? So to the downside. Now think about it. If we started out here and just like a long call spread, if the market starts going up, the value of this call spread right there increases in value, right? So as this call spread increases in value, it starts paying off. Long call spread, that's where we make the most of our money. But think about it. Now that call spread is at total value, and in this case, it's $5, right? So we've made $5 on that move higher because we're entering it right here. This is where we kind of get into the trade. So as this market moves higher, this call spread increases in value by $5. Now we go over this short strike here on the 129s. Well, it starts, we see our max profit start going down, or our profit going down, right? And the reason why is this call spread is worth $5, and it's staying worth $5. but now we have a short call spread here, right? So as that call, we start going down, right? This call spread is paying off our losses here to $5, right? $5, and we get the credit of 44 cents. But that's why to the upside, we have that wiggle room to the upside, because that long call spread is, paying off. But this one, then all of a sudden, this short call spread starts hurting us a little bit. Does that make sense? And then once this $5 has paid off the width of this $5, this is where we have that embedded short call spread. Once that short call spread is starting to hurt us, then there, the embedded short call spread that I spoke about. That makes sense? All right, cool. Perfect. All right, so that's why we're looking at the skip. We look at that skip strike plus the credit is our break even, plus the width of that long one. That's that long one I was talking about, because the $5 pays it off to that skip strike there. All right, when we're doing this though, we're going to be looking to do this for 50% of max profit. All right, so we know our max profit, and that previous one was $5 and I think 60 cents, right? Because we got that credit, $5.60. We're going to be looking to get out of this at $2.80. All right, that's where I want to get out. All right, so it starts out as a 60-cent credit, and then if I can get out for a $2.80 credit, that's where I'm going to look to get out of this. And as long as it doesn't happen overnight and goes to that mark right there, if we start getting the market kind of trickles around and then we kind of get it to move higher, over the course of several days, then, you get to where it kisses that short call spread or that short calls. That's going to be very close to this. All right. It's going to be very close if we go up there and hit that short strike of ours. All right, that's where I'm going to be looking to cover this trade when that happens. Now, when we're doing this, let's go through the steps. This is kind of our roadmap. We've come up with an assumption where we have a neutral, slight. We want it to go up a little bit. As most markets kind of trickle higher, but we have a relatively market neutral assumption, all right? But I'm worried about the downside in XYZ, all right? So we're going to be looking at XYZ. Is it the right underlying to trade option? This is for trading for options, all right? Yes, you could go out there and buy any stock. The markets are pretty tight in most of them. So what I'm though worried about is XYZ, good for trading options. And one thing we're going to look at here is volume and open interest. We want to see where are the eyeballs, all right? We can look at Aon. Everybody's heard of Aon in here, and we can see that these markets, it's a $200 stock. It's 40 cents wide, which actually isn't too bad for Aon. This would be a yellow light for me, all right? Because my rule on any stock that is over $100, so if it's greater than $100 stock, then I want the bid to the offer in the option montage to be equal to or less than a decimal move, 3 decimals. All right, so basically 1, 2, 3. So in this case, 20 cents or 19 cents, really, to be exact. 19 cents is really where we want it to be. So in this case, we want it to be less than or equal to 19 cents. And that would be, that would be a green light. Right now, the way that the markets are going, basically, if it is 2 times my rule, then that's a yellow light. And anything over this, anything over that greater than, then that's a red light. Okay. So right now, Aeon would be kind of considered a yellow light, because you can see from the bid offer, and you want to look at the close 35-ish days to expiration. That's where the most eyeballs are. And so this would be, a yellow light very close to a red light in Aeon. We can take a look at something else. Let's look at Philip Morris. It's a $60 stock. So this is any stocks that are less than $100 stock, all right? We want it to be the bid offer to be less than or equal to 10 cents wide, all right? So that would be our green light. And basically, I would say any stock, that is less than $100 stock, we're looking at a yellow light if it's 2 times the rule. And I usually don't do this in some of the other webinars, but we're in unprecedented type of circumstances. So 2 times the rule. So Philip Morris, for the most part, is just outside of that, making it more of like a yellow light. And this is also after the market's closed, right? Right now we're looking at this to be at, a lot of offers markets are canceling. So it's getting a little bit wide here. All your orders get canceled as soon as the market closes. Another thing to look at, just make sure there's a lot of volume and open interest in here. It's decent, which is why the markets are a little bit wider in here. But if you were to look at something like Apple, you'll see that, it is $300 stock. So I would say right 30 cents to the bid offer. These are like 10 cents wide, and this is after the market's closed. So that's, we want to look at this during open market operation. So as you can see, the volume and open interest is huge in here compared to even Philip Morris as a cheaper stock, right? You can look at Walmart. It's $100, over $100 stock. My rule would be 12 cents, just slightly inside of that for the most part. So that makes it a stock that is tradable for options, all right? So, Walmart, even after the market's closed, would fit that rule, all right? Could I go back to the previous slide? This one, break even, or the profit target? We good there? I don't know, maybe I answered your question as we were going. So that's picking the right underlying, XYZ for options. If it's less than or equal to $100 stock, then we're going, less than or equal to 10 cents. That's, that's really where we want it. I can't figure out how to change my pen off of a red right now. I thought I figured it out the other day. Ink color, that'd be a green light. There we go. So that's this would be a green light. All right. And then yellow light would be 2 times that rule. And if it is, it's kind of a pain to do this with this. Got too many steps. And if it is greater than $100 stock, then remember it's 3 decimal moves. 3 Ds left. 1, 2, 3. All right. It's an easy way to figure it out. Not finding that on Investopedia. All right. So picking the right environment. We talked about this already a couple of times. We want high implied volatility. All right. And we're not talking VIX. All right. I'm not saying it's not the VIX. The VIX will give you an indication of high implied volatility across the spectrum, okay? It's a good indicator as to where volatility is, in the current environment, but it doesn't tell us for every single stock whether or not that particular stock is getting high implied volatility. It doesn't work that way. Each stock is its own beast, and every stock has its own volatility coefficient. So, we could go over here and look at Walmart, for instance. It's a $100 stock right now. Implied volatility is 37. I could go and look at, General Dynamics, and it's 43, right? Does that mean that General Dynamics has higher volatility? Yes. But does that mean that volatility for General Dynamics is high? So what we look at is we go over here to this chart over here, and we can see that right now, General Dynamics, despite this big sell-off that we saw, everything's getting that mountainous move. But we can see that 44 for General Dynamics is pretty high from in the past. Same with Walmart, but you can see that it is pretty high right now. All right. We can look at something like Tesla. Let's just look at an extreme example here. And Tesla, 81, that's where it's normally been at the highs, but 81 for Tesla, if we were looking over at the pricing, right? It's 84 here, but then we go over and look at Apple, which is you know what? I'm trying to find some stocks that actually, we'll just look at Apple since I already have it halfway up there. Oops. American Airlines. Apple. There. Apple is 37. So, 37 for Apple, it got up to one here, but, we were looking at Tesla being way up here. Apple rarely gets up that high. So you can't look at just that number and say, okay, 80 is high, because really 80 is really high for some stocks, something like Gilead, I doubt ever gets up to I guess it did, but that's on their drug things. Let's look at something else. What would you get up there very high? Gold doesn't get up to 80. The high for gold is 50, and that is probably a historical high for gold. And normally it's pretty low. So what we need to know is this volatility is beneficial in telling us, I talked about this already, volatility when it's high means the premiums are high. Well, it means the premiums are high for this particular underlying, okay? So what we're looking at is, so we did the iron condor last week, and yes, I did put on the iron condor around gold. So what it tells us is that the iron condor, or the premiums, are pumped full of, juice. So you're able to get further away, and when I talked about it, if I were to do an iron condor in a normal circumstance with this particular underlying, I might have had, when I set this up, had to sell like the 155s and buy the 150s or something like that. So my wings would have been much tighter then. Okay. So we want these premiums pumped full of juice so that we can get further away from where the underlying is currently trading. Does that make sense? So we want this to be high for itself. We can tell normally volatility for gold is way down here. Now we're in a different kind of paradigm. We want volatility to come out of this trade, because as the volatility comes out, the premiums come out. All right. We also want to get the right duration, because this goes to talking about theta, right? We want that theta decay going on. And theta starts really ramping up. And I got a white pen going on here, I bet. So I've got to switch my pen, ink color. I'll get used to this. So we can see 35 days to expiration down here. This is theta decay, and it really starts ramping up. So what I talk about, floor, we used to say theta is the thief in the night to come steal your premiums. You wouldn't want to set this strategy up way out here. There's no theta decay. What we want to exploit theta decay. Well, that's because we're collecting a credit. Anytime you you're collecting a credit, you want theta decay happening because you want to sell high and buy low. All right. So we want to be able to get that theta happening. So there's two short calls, expire worthless. Well, the best way to do that is in this kind of environment here. Now, one thing to note with volatility is when we're looking at how it affects these premiums, what volatility does, and remember I kind of mentioned this with a balloon, volatility pushes up on the premiums, right? It inflates those premiums. And this is, a representation of what the premiums are doing over here, options pricing. So with volatility, I'm looking at vol kind of pumping up on this line. What it does is it kind of pushes it out, all right? Makes this line kind of flatten out or maybe even increase as those premiums go up. Now, when that volatility comes out, it comes back down, catches up with the curve. So this is, where our money is made. When that price of those premiums goes down, well, we sold it for a credit. Now, all of a sudden, all of our premiums come out. The probabilities of us, getting our short strike tested come in because probabilities are kind of, a correlation to volatility. And the VIX, when the VIX is up in the 40s, I think that's basically pricing in, about a 40 is about a 4 to 5% daily move, right? When we were up in the 80s, that was close to a 10% daily move. So when the probabilities of that kind of move are happening, well, those premiums get pumped up and our wings get very wide, right? And then when that volatility comes out, it all kind of contracts on it and just kind of implodes on itself. And that's what we want. We want that implosion or volatility crush coming in so that we can have it catch up on it. Profit target side is not clear. Is it that the max loss you would get out? No, the profit target, our max profit, right, is the width of that spread, or in our case, $5. Well, if we're looking at 50% of that max profit potential. So $5, 50% of that is $2.50, right? And we also got to keep in mind we collected a 60-cent credit in my example. So 50% of that is 30 cents, $5.50 plus the 30 cents, $5.80. Or the $5 plus our max profit was the $5 plus the credit, $5.60, $2.80. All right, so we want volatility to push up on our premiums. So that's why I was talking about we want high volatility, and the expectation volatility is going to come out so that we get this happening to our premiums. All right, now we got to pick our strikes. Remember, all else, we got to collect the credit. That's why I usually use red. Collect the credit. We want to collect a credit or for zero money, all right? Always do that. You can set this strategy up where you do it for a debit. I'm not going to lie, because, if you're a little bit more directional, which I don't have a problem with, you're a little bit more directional and you're picking, we're not doing the at the monies on that to build this out. And you want to go a little bit further, the further out of the money you go, it's going to be closer to a debit, all right? And if you start getting to a debit, don't do it, all right? You're just increasing your risk on both sides. So without further ado, let's get on with it. Know your exit strategy. We talked about that. 50% of max profits where we're looking at. So let's go back to that. I want to do IWM. I don't have a whole lot of exposure to IWM. And, IWM is the ETF for the Russell 2000, all right? So there's a lot of stocks in there, right? And think about this. If there's there's 2,000 stocks in it. if there is that many stocks, there are going to have a tendency, and Russell usually does this pretty good, where it's maybe a slow trickle up. You can see it didn't gain that much usually. Now we are in unprecedented times, but the premiums, as we can see, are reflective of bigger moves. Well, what did I talk about? This means that we can make our wings wider, right? As volatility pumps up on the premiums, we can see that we are able to get a lot more bang for our buck, especially if we expect volatility to come out. Now, for me, if I'm looking at this particular trade here, I'm kind of thinking it's, it is trending higher. We are kind of making that move there, but I'm kind of expecting this market to come up and, whoops, I forgot to put my pen on there. Let me get my pen back. I'm kind of expecting this market to kind of make a bit of a bounce and trend sideways a little bit here. There's a lot of financials in here, and there's a lot of healthcare in here. So I think that those are going to counteract one another. Yes, healthcare, I think, is going to probably come up with something. I think it's Teladoc is one of the big ones where you can basically go online and talk to a doctor and he can prescribe drugs. That company could do very well. It could actually get bought out by somebody and really do well. Well, it's only like 0.74%. It's not even 1% of the whole thing. So, and that's like the biggest holding. Then there's all kinds of financials in there. There's consumer staples. It's just a hodgepodge of everything. And well, this market is flinging around. Yes, it's felt some volatility here, but I think that now that the news is out, it's going to want to kind of trend sideways. But I am worried about the downside here. I am not too concerned about this upside. So that's my thought process. When I'm looking at the charts, we come up with our own market assumptions, however we come up with it. This is just what I'm coming up with. And one of the things I mentioned with this is you can see that we have high volatility right here in comparison to where it's been in the past. Yes, it's not as high as it could go, but in the past, you can see it's really high compared to where it's been. So I think volatility is going to come out. I can see it's got high volatility right now. So I'm kind of expecting this volatility peak, to continue to kind of slough off a little bit. And this isn't a trade recommendation, just so you guys know. I'm not trying to talk you guys into this trade. I'm just kind of giving, I'm giving a scenario that that is plausible, right? All right, so we mentioned we're going to buy this one that's out of the money. I think it might have even already done this one. So we're going to buy the one that's out of the money, go $5 higher because, another little floor trader hack is, that first credit that you buy for, I'm looking at this. All right, $6. Well, that's, I probably could go $6 wide, but basically that first credit or that first debit you pay for, you're looking at that and saying, okay, that's about how far away I need to go on my next strike. All right. So then I go $5 higher on this, and that is the 24th, so the 29s. I'm going to sell that one twice. And then a normal butterfly, like I said, you'd go to the 34s, right? That's your regular butterfly. You're doing it for a debit. Well, I'm selling an embedded call spread in there and then going out and buying it another $5 or selling a $5 call spread inside there. That creates that credit. Eliminates the downside risk because the short call spread that I just did, that embedded short call spread, pays for the width of this call spread, right? Normal, the $5 call spread here, I sold a $5 call spread. That pays for my risk to the downside, that embedded short call spread that I just kind of went through that process with, right? That pays for my risk to the downside, and I still get to keep the credit. That's why when you go over to the Analyze tab, my max, I don't have any risk to the downside, but we're looking at that as that 45 cent credit. That's that difference here. So my short call spread that I kind of looked at, that was that embedded short call spread that I talked about, right? This call spread here, pays for my risk there. Okay. So you don't have that risk there. I see your question. I'm just trying to think right now. In the break-even calculation, the width of the long call spread is which spread? In the break-even, the width of the long call spread is which spread? The width of the long call spread is the 24.25. Remember, we don't have any risk to the downside, so there's only one break-even. So when we go to analyze the trade, we're starting out like right here. So as the market goes up, this long call spread, this is our long call spread right here, long call, and we got two short calls right here, right? So our long call is the 124s, and then these are the 129s, short two of those. So this particular call spread here, as the market goes up, it starts gaining in value, right? So you get to the 129s. Well, this is worth full boat. The 124, 129s worth that $5. Well, that $5 is getting eaten away as we lose money on this short call spread. We got a real big short call spread to the 139s, right? Okay. A 1/3/2. Is that more ratio butterfly? No, it's I haven't looked at the margin requirements on that. It probably has a little bit more margin requirements on it because you're adding another short call spread in it. I'd have to look at it though. So your break even is right here. And remember, see, that's at that 134 strike. 134 strike plus the credit received. So my break even is 134 to the upside plus the 45-cent credit. 134.45 is my break even. All right. And then my max loss is from 134 to 139. Or 134.45 to 139. Okay, so you can see here, we've got a lot of room to be wrong, right? All of that room to be wrong, and this much room, or sorry, yeah, if we're wrong going all the way to there, and then here. So we've got a pretty good opportunity here. And I'm not worried about this side. So, but this is my question. Are we going to have a correction to the downside? So I'm worried about that. There. So you can see here our max profit then is $5.45. That's what that's showing across there. I pull up a line here. Should be right around here. I mean, I'm ballparking the idea there. And then my max loss, if I drew a line, which should be about 475. That line's not straight. I can't adjust it with this thing. But 475 would be my probably, 475 is probably like right there. That's pretty straight. 465. 455. Math losing me now. All right, so just one other thing, I mean, if we're, I kind of went through this. a little bit, maybe not as in detailed as this. This is an old example that I just found. You can see the regular butterfly. You're going to have 2 break evens. You're also going to have buying power effect. It's a debit, your risk on that. Obviously, selling that short call spread is going to increase your buying power effect by that short call spread, really. You end up doing it for a credit in this one, and you're increasing your risk, but you are going to have to put up a little bit more money for it because of that short call spread. All right. All right, without any more questions, you guys, I just want to thank you guys all for taking part in this. I appreciate all the questions. I think that there's so many people out there that have questions that when you ask questions, it really makes this thing work out well. And another reason why I say watch this again, and maybe not necessarily this one, is because people asked different questions in the last one that might be applicable to what you were saying or thinking, and maybe didn't want to ask a question or something. So take advantage of this for $479. You can't beat it. A bad trade by Investopedia, just kind of trying to do it yourself. It's you learn by hard knocks if you want. Everything has its price, but for $497, you can avoid a lot of mistakes with all of these things. And I hope that you guys found this educational thing a little bit where it sticks in your brain, or I got to you. It made sense somehow. Whereas maybe I'm sure if you watched me in this webinar, you watched somebody else. If what I said kind of clicks with you and you're learning, then for this price, you guys can't beat it, and you should take advantage of it. The link is over there in the chat window. Take advantage of that. It's an easy hot link. If you're watching this on tape delay, you're going to have to do the link up there and type it into your URL. Thanks, James. Appreciate the kind words. But if this sticks with you, you guys should take advantage of it. I try to answer the why as to what makes people click and what clicks with them. And I think about how I learn, like the thief in the night. You guys probably are never going to forget that. What is theta? There's people out there talking about all these Greeks and don't understand theta. I even have friends that trade options and do them the long, I'm going to buy a long call spread, or I'm going to do a long call right now based on my market assumption being bullish. And I'm like, dude, have you even looked at what kind of environment we're in right now? I mean, buying long call spreads and high volatility is not the right thing to do. It just, I don't care about your assumption. It's just like set yourself up for success. And buying long call spreads and high volatility is a low probability strategy. You are swimming upstream. So I try to talk about those kind of things and the reasons why you need to have your market assumption first off and foremost. But then it's let's look at the underlying. Let's look at all the details. Let's get under the hood and see what's really making this thing click and what's going to make it work. And that's what I do in these webinars. And hopefully you guys can find some value in that. And that's what I try to do for you. So for $497, you get all of this stuff, historical volatility versus why I look at implied volatility versus historical volatility, probabilities you're going to be making money on a trade, all of those things. Different floor trader hacks that I come up with. Those are streamlining your processes. This is going to make you sleep at night, all right? Options basic. I see a lot of new faces out there. Take advantage of it. How to calculate the cost of the option. If you aren't very familiar with Black-Scholes and all that stuff, you don't want to go through Black-Scholes. I talk about how you can avoid all that. And then setting up how I trade, how I come up with my market assumptions and how you can trade in and around the different things that we're looking at, market trading gamma, trading market profile. If you like shorter duration trades, you want in and out, you're only thinking for a couple of days in advance, or thinking you're going to make a quick move on something, and trade with using gamma, but also market profile and stuff like that. So take advantage of that. Like I said, it's over there in the chat window. And finally, I want to say thank you guys all for being a part of this webinar. It makes it go much faster, and I think you guys get a lot more out of it. Later webinars, I'll drill down on different option components, when and where I find those trades appropriate. Check out the daily market commentaries where I talk about all my trades. I'm probably going to be putting on this IWM broken wing called Butterfly tomorrow. I think it'll fit my portfolio pretty good. That's what, I don't talk about just the winners in my webinars, you guys. I talk about those losers when it's going and it's in my face, and I have to stay mechanical and lower the overall cost basis on it in order to be successful. Those are things that we need to do on a daily basis, and with our portfolios. The IWM doesn't have to be implemented around a portfolio of stocks you have right now in this trading portfolio. You have to look at your IRA. You have to look at your 401k and stuff like that. What's over there in that 401k? Those guys are usually buy side. They're not shorting anything. So that means you are, hell bent on the market going up to make money. Well, if you start putting on trades like this, well, that hedges some of your risk, right? The market goes down, at least keep the credit and stuff like that. So take advantage of that. If you have any questions, reach out to us at 310-598-6677 or trading@protraderstrategies.com. All right. One last thing, please take a moment to go over the disclaimer. We are an educational company. I'm not trying to get you guys to lemming off the cliff with me. I do not agree with the herd mentality of trying to get you guys to buy trade recommendations and all that stuff. I don't do that. I try and teach you guys how to swim. I'm not here to swim for you. Alexander, we will be sending out a replay. And if you guys ever don't get that replay, look on Facebook and stuff like that, because usually they get thrown out a couple days later on there. Like I said, we put out a lot of content on there. All right, guys, that's all I got for you. Other than, if you can't take that, take it easy. Take care. Thank you guys all for your kind words. Have a good one. Bye for now.